Welcome guys. This morning we're going to be going through some prep for the Reserve Bank of Australia meeting. First of all, what I'll touch on is a little bit of background on the RBA, then about some background about Australian rates now and historically. Then we'll move on to what the market's pricing ahead of the meeting. The market is actually having some talk about a rate cut coming up. So we'll go through some of the factors and some other reasons for and against that the RBA might think about, and then finally we'll go into some more interesting stuff regarding what you guys are here really for, which is trading and some of the markets that we can trade: Aussie dollar, Aussie bonds, equities, or even US bonds. So where I'll start though is with a little bit of background on the RBA itself. So they are an inflation targeting central bank. Most central banks these days are inflation targeting, and the Aussie bank's no different. Their target is to keep inflation within a 2 to 3% band. And as we've talked about many times, that's generally a medium term band. Most central banks do look through a bit of noise in the short term. So they've got a 2 to 3% band that they look to keep inflation within. They meet 11 times per year. Them being on the first Tuesday of every month apart from January, where there's no meeting. Don't ask me why there's no meeting in January, but that's just the way the RBA are. The rate decision will come about at 2:30 p.m. Sydney time tomorrow, so 3:30 a.m. London time. And the format is there will be a release of the interest rate decision and a statement. The statement will come as kind of the Bloomberg / Reuters dump. It's not like the ECB where it's read out by Draghi. And the statement will be available on the website straight away, the RBA website. There is no press conference, there is no Q&A, there are no updates to economic predictions. Now, the RBA does update these quarterly, and these occur in the Statement of Monetary Policy, which the next one is in May. So it really is, it's just the release of the interest rate decision and a statement. You don't actually hear from the RBA afterwards. So just to put things in context, Australian interest rates at the moment are a record low 2.25%. They cut at the last meeting 25 basis points. Going into the last meeting, it was pretty much 50-50 priced in as to whether they cut or not. And ultimately they did deliver a rate cut. As you can see, Australian interest rates have been pre-crisis as high as 7.25%. We've had, over the financial crisis, a drop down to 3%, but then the Australian Central Bank, the RBA, they did raise rates, which is no other central bank has really done. They did raise them from their 3% emergency level up to 4.75%, but then they've actually cut rates since that. Prior to this last cut over here, they were on hold for 18 months, and it was only in the last meeting in February that they actually cut rates to 2.25%. So as I said, it's a historical low, and 2.5% they were there for 18 months prior. Now the reason that the RBA did cut rates, and the main reasons they highlighted previously were: one, declining inflation. As I mentioned, the RBA are a inflation targeting central bank. Inflation currently is at 1.7% headline inflation, which is below that target band. Obviously, central banks often do look through short-term inflation effects, but the RBA decided not to in this instance. Another reason they flagged, and another very important reason they flagged, was the declining commodity prices. Now, the Australian economy is very commodity intensive. Iron ore especially accounts for about 20% of their total exports. And iron ore prices, much like most commodity prices, much like oil, much like gold, they've dropped 50% in the last year. So if that's 20% of export revenue, a 50% drop is a hell of a decline in exports. So that's another reason why they've cut rates last time around. Another reason, sub-trend growth. Target growth in Australia is 3%. They've been growing about 2.6 to 2.7% year on year. Global uncertainty. Well, there's a lot of uncertainties around with regarding to China, Europe, low oil prices. That's another reason the RBA flagged last time round. And finally, the relative strength of the Aussie dollar. Now, the Aussie dollar has come off quite a bit, about 20-25% in the last 6 months or so, but it's still a lot stronger than the RBA would like. They've talked about having an Aussie dollar around 75 cents. We're still around 77, 78 cents, so we're not that far off. But the fact is, the declining commodity price is 50% lower against 20% lower Aussie dollar. It doesn't really stack up. It doesn't really, I guess it doesn't really soften the blow of weaker commodity prices. So that's why they actually decided to cut rates last time round. A lot of these reasons will still hold true this time round, and potentially reasons that they may well cut rates again. Now, what I generally do going into any central bank meeting is look what the market is pricing through the short-term interest rate markets. Now, the data I've got up there on the board are the interest rates that's priced into the market. So if we know the current RBA cash rate is 2.25%, we see for March, i.e. tomorrow, the market is pricing 2.11%. So essentially the market is pricing 14 basis points of rate cut. Now here I've said the market's pricing 56% chance of a rate cut. So generally the RBA moves in 25 basis point increments. If the market is pricing 14 basis points in, 14 divided by 25 gives us a 56% chance of a 25 basis point rate cut. So this data here is actually from OAS markets, but you can actually imply this of the 30-day futures contracts as well. 30-day futures contracts in Australia work pretty much the same as the Fed funds in the US. Okay. So the market is pricing 56% chance of a rate cut in March, so pretty much 50-50 as to whether they'll do anything or not tonight. And as we see 2.01% here, it's essentially fully pricing one cut by April. So whether they cut at this meeting or not, the market is pricing that they will cut in either this meeting or the next one. And that in itself creates a few potential trade opportunities for us. One, if they do cut this time round, because essentially this becomes 2%. Or if they don't cut, it'll be interesting to see if they're still pricing in a cut for the next one. So there's a few things to look at. Part of it will be the rate decision, part of it will be the rhetoric or the statement they come out with. And hence this meeting is very much live. It's very much a kind of, the market is watching this. When I say live, you often get meetings with central banks where you know they will do nothing and you're just listening to the statement or trying to read the statement and interpret. This is something that there is a very high chance or a good chance that there will be an interest rate move. And just going further along the curve, we see 1.76 here, 1.76%. So the market is pricing the best part of 50 basis points of rate cuts by August, as indicated by this 1.76%, given that we're at 2.25% now. So essentially two rate cuts are priced over the next 5 or 6 months, with one of those priced over the next 2 meetings. Any questions, anyone? Okay. And just for further context, the Bloomberg survey, 18 out of 29 economists are calling for a March rate cut, which pretty much is a similar probability to what the market's actually pricing. We often see that. I'm always a little bit skeptical about what analysts and economists say, because often the market can price in something very different to the analyst community, but we're fairly close here, unlike with the Fed, for example, where a lot of the analysts are calling for mid-year rate hikes in the US, but the market's pricing at essentially a December rate hike in the US. So this table here, it shows a few arguments for and against a rate cut tonight at the meeting. So we'll go through the 4 arguments first. Number 1 being disinflation. As I mentioned, headline CPI is at 1.7% and is below the target band. Unemployment rate in Australia is 6.4%, which is at 12-year highs. Another reason potentially for a rate cut is, as I mentioned again, the relative strength of the Aussie dollar. Although it has come off, it hasn't come off enough to keep the RBA happy, especially in terms of what I've mentioned about the low price of iron ore. It is Australia's biggest export, and it is at its lowest level in 5 years, and as you can see, it's dropped from $125 to $62 in the last year, so almost 50, probably slightly more than 50%. Now the RBA in the past have actually talked about 75 cents as being more fair value for the Aussie dollar. We're not too far away from that. We're around 77 cents at the moment, but they've generally talked about that when commodity prices were a bit higher. So if anything, they'd probably, in my view, want a lower Aussie dollar than 75 cents to make up for some of that depreciation in iron ore prices. And it's not just iron ore. I mean, I flagged iron ore because that's Australia's main export, but coal prices, it's the same thing. Australia is a big coal producer, and you've seen a similar dip in that as well. Another argument for rate cut is sluggish domestic growth. Again, I've said it's been below trend at 3%, so Australia's been growing about 2.6%, and it's been below trend for the 6 out of the last 7 years. So it's not just right this moment in time. It's kind of been a long-term effect. I mean, by most standards, 2.6% is pretty solid growth, but for Australia, it's lower than what they're used to. I put slowing Chinese growth on here as well, as a reason for them potentially cutting rates. Now, China is Australia's biggest trading partner by a distance, and a slowing China generally means a slowing Australia. China, it's the Chinese that invest in Australia, it's the Chinese that are the biggest importers of the Australian iron ore and the Australian coal, so any slowdown in China really does hit Australia significantly. And finally, in terms of rate, another reason for a rate cut is that the CapEx expectation survey data for forecasts for financial year 2015-16 was very low. Came in at 109 billion versus 120 billion expectations. Now this piece of data is very important for the Australian economy, because essentially mining in Australia, as we've said, has been very strong, and these CapEx expectations essentially show a shift, or the potential shift, from the mining sector to the non-mining sector, CapEx, capital expenditure. Now, the fact that this number came in weaker than expected and the RBA anticipated, it will be a worry for the RBA that the transition from mining to non-mining is much slower than they would like. Essentially is a measure of investment in the non-mining sector, and it's much slower than they expect. So those are all arguments for the RBA cutting rates. Now, the arguments against are, again, similar to some of the arguments for. So we've talked about disinflation being an argument for a rate cut, but inflation could essentially be an argument against it, because the central banks generally look at core inflation or underlying inflation that strips out volatile things like petrol prices. Now that is at 2.25% currently and still within their band. So that's potentially one reason why they might keep rates on hold. Although last time round they did flag inflation as a worry when they did cut rates. Also another reason, the RBA just hiked rates at the last meeting. So is there a need for them to go back to back? Maybe they'll just give it time to see how the last rate cut played out. We're at historical lows in interest rates. Does it really harm them to leave it a month, 2 months, 3 months? Maybe, maybe not. So that could be another reason. The impact of the rate cut probably hasn't fed into the system yet. Now, we talked about the Aussie dollar being relatively strong, and that could be an argument for the rate cut. But by the same token, they cut rates last time, and we're actually, the Aussie dollar is higher than where it was. So is it really having the desired effect? Maybe, maybe not. Why should a cut in rates now make the Aussie dollar go down? But by the same token, the RBA can be thinking, well, maybe we need more for it to go down. Maybe that wasn't enough. I will show you a chart of the Aussie dollar a little bit later now, and we can put this all into context. I mentioned lower petrol prices as another argument that may prevent the RBA from cutting rates. Now, we've seen commodity prices are low in Australia. In terms of oil, petrol, Australia is not a producer, so they see any benefits from low oil prices, lower petrol prices at the pump. You know, consumers will have more disposable income because of these low petrol prices. Yes, this does feed into inflation in the short term, but as we've seen many central banks talk about, oil prices are generally low oil prices are a positive medium to longer term, and perhaps the RBA will see that way as well. Now, probably the biggest worry for the RBA if they do cut rates, and what might prevent them from cutting rates, is the housing market in Australia. That is very much booming. I mean, in the last 3 months alone, we've seen 10% annualized year-on-year increase in house prices, especially in Sydney and Melbourne. For example, in Sydney, they really monitor auction clearing rates. A lot of the housing sales in Australia are done by auction, and you're still getting 80% clearing rates week on week, especially in the Sydney housing market. So the RBA will be slightly skeptical about cutting rates further, because what do low interest rates do? They make borrowing cheaper. They make getting a mortgage less expensive, and this could actually add fuel to the already strong housing market. So that, in my mind, is probably the reason why the RBA would be very hesitant in cutting rates one more time so soon after we've just had a 25 basis point cut. And the final point, we talked about slowing Chinese growth. Very fresh in our minds now at the moment should be that China did cut rates this weekend by 25 basis points. They cut their 1-year lending and deposit rates by 25 basis points. Now, you could argue, well, China have cut rates, maybe Australia will follow suit, but then again, you could argue, actually, they're kind of doing the RBA's job for them. They're adding stimulus to their main trading partner. Maybe this stimulus will have a follow-through effect onto the Australian market, into the capital expenditure, into the mining sector, into the non-mining sector. So maybe that may be one reason why the RBA may be less likely to cut rates again, that China have essentially done them a favour this weekend. So as we can see, it's not clear cut, it's not simple, and the kind of the 55% priced by the market for the rate cut seems pretty fair. There are reasons for, there are reasons against, and that's why this meeting coming up tonight is pretty interesting and very much live. Okay, now on to the more interesting stuff on the markets. So the markets I'm going to go through briefly are the Aussie dollar FX market, the Aussie bonds and stairs, Aussie equities, and US bonds. Okay, so first of all, the Aussie dollar. Now, as we can see, since third quarter of last year, it's been one-way traffic for the Aussie dollar. We've gone quite significantly down from 94 cents down to where we are at the moment, just under 78 cents to the dollar. Now, following the last rate cut, we were here. So what happened? As soon as they cut rates, the Aussie dollar spiked lower, bounced back pretty much instantly, and we've been in this quietly tight, coiled up market since. Now, we talked about the RBA, wanting to cut rates potentially to dampen down the Aussie dollar further. Clearly, as this chart shows, it hasn't really done it. The last meeting, February the 2nd or February the 3rd, we're actually higher. So in terms of potential trade opportunities, we've seen the market coil up around this kind of essentially best part of 77 to 79 cents range. Drawn a little trend line here. Potentially, if they don't deliver on a rate cut, we could break back above this trend line here and actually see a bit of a reversal and a retracement of some of this move here. We could essentially see a similar thing, not just if they don't cut rates, but also if they do cut rates and indicate that's pretty much it, that they're not going to do anything further after that. Why? Because we've seen from the market pricing that there are 2 rate cuts priced over the next 6 months. If they do one and say kind of we're pretty much done, we think we'll just leave rates on hold for a while after that, you could actually get another rate cut and the Aussie dollar go up. So this trend line here is around the 79 cents level. I think on those scenarios, if we break above there, we could actually extend higher in the Aussie dollar. And by the same token, to the downside, if they do cut rates and continue to be dovish, then this low here at 76.26 becomes quite significant as the last previous low. So in terms of FX space, I think it's quite clear that I think that essentially for me will be breakout opportunities either way, because we have been coiled up in this pretty tight range. Any questions on that, anyone? Okay. The next thing I want to flag up is about the Aussie bonds. Now, from the chart, this green line here, is that correct? Yeah, this green line here shows us 10-year Aussie bond yields. This purple line here shows us 10-year US bond yields. So what we've seen is the market has generally, since the last rate cut, been fairly, the yields have gone down slightly, about 30 basis points from the middle of the month, but the middle of the month was post rate cut. So we started off similar to the Aussie dollar, at yields of around 2.44%, got this spike down in 10-year yields, then have actually bounced back up in a similar fashion to the Aussie dollar. Now, what I think is quite interesting is not so much what 10-year yields in Australia have done, but what they've done relative to US 10-year yields. You see they've been quietly tightly correlated up until that rate cut. Since that rate cut, we've seen US yields move the best part of 50 basis points higher. The Aussie dollar, it just hasn't, the Aussie 10-year bond yields just hasn't followed suit. You've seen the spread between the two widen quite significantly. Why? US yields have gone up, Australian yields have struggled. And another chart that will just show this a little bit clearer is this one here. So it's a spread chart between Australian 10-year yields and US 10-year yields. And as we've seen, since essentially when they cut rates in February, the 10-year yield spread has gone from 90 basis points to 50 basis points in the last month. 40 basis points of tightening, essentially, between Aussie and US yields. Now, why I think this is interesting and why I brought this chart up is this shows a yield differential in the long end between 10-year Aussie yields and 10-year US yields. Now, in FX space, we've seen a very tight, coiled up market. What is a foreign exchange? Aussie dollar spot rate. Essentially, it's interest rate differential in the short end of the curve. And what we've seen from the FX is the spread, essentially the Aussie dollar interest rate differential in the short end has done hardly anything. Whereas 10-year yields, we've seen this move from 90 basis points to 50 basis points. So in the time where the Aussie dollar has been called up in like a 2-cent range, the 10-year bond yields have moved 40 basis points. Now, I wouldn't expect that at all. I'd expect them to move in a very similar fashion to each other, the FX and the 10-year yield spread. So an opportunity here for me is this has probably moved a bit more than it should have done when you look at it against what the spot FX has done. So if the RBA do disappoint the market and don't do anything, or are fairly upbeat on the economy, or they say one and done, what I'd expect is this spread to widen back again. So I would look to potentially sell 10-year Aussie bonds versus buying 10-year US bonds, looking for this, I guess, this yield tightening to unwind a little bit. I mean, if we go back historically, early 2011, the spread was at 2.5%, and now it's at 0.5%. So we've seen a very significant contraction in that spread. So I'd expect a little bit of unwinding and reversal of that. Should the RBA indicate that they're done with cutting rates, or if they do a one and done type scenario. So I guess what's important also, guys, is to focus not just on what the RBA do, but on their statement. In the past, one of their buzzwords have been period of stability. When RBA have often referred to a period of stability, it's meant rates are going to be on hold for a while. So if we hear that, or see that in the statement rather, that could be seen as kind of very Aussie dollar positive, and in terms of this spread of yield spread, it'll be kind of cause a widening in the spread again, cause a bond market sell-off, an Aussie bond market sell-off. So that chart I find particularly interesting, especially given the context of what the Aussie dollar has done. Now, I often look at stirs as well into central bank meetings and look for risk-reward trades. We've seen that the market's pricing 55% chance of a rate cut. For me, there's not that much risk-reward. You're essentially flipping a coin. I often trade the 30-day futures looking for something at the extremes of pricing, whether it be zero basis points priced in or a full 25 priced in. Now, the market is pricing 14 basis points. It's here nor there for me, so I don't see the risk-reward opportunities in the stirs this time around. For those of you who've been at Futex a while, you know generally whether it's FOMC, whether it's RBA, whether it's ECB, I generally like to look at these risk-reward plays in the stirs. There isn't a decent risk-reward play at the moment, so I will be staying out of the stirs and just looking at them as a guide this time around, as opposed to actively trading them. Anyone got any questions about this bond spread or anything like that? Okay. Moving on to the Aussie equity markets. Now, it's pretty clear that the market has been very, very bullish. Most equity markets in general have been. If you look at Europe, Euro stocks at all-time highs, FTSE pretty much at all-time highs. The Aussie equity market, the ASX 200, is not actually at all-time highs, it's at 7-year highs. But it's quite telling what has happened essentially this year. And although they cut rates in early Feb, it was really around the end of January that the talk of the rate cuts came about in Australia, and ever since we've seen just pretty much straight line up move in the equities. And it's pretty much been one-way traffic. We're at 7-year highs here at the moment. I expect on a rate cut or some dovishness out of the RBA, this will continue. Remember what we've talked about before, equity markets are happy with lower interest rates. The lower the better for them, generally speaking. They want firms to invest, they want capital expenditure, they want firms to be able to borrow. Lower interest rates means for savers, for consumers, they're less likely to save and more likely to spend. So again, the equity markets have, as we can see from here, liked the lower interest rates, they've liked talk of the lower interest rates, they've probably got dragged along by European equity markets to an extent. We had a further spike up on today on the China news. Now, if the RBA don't deliver a rate cut or indicate they may be done, we might see some sort of retracement of this equity. It looks a very bullish market at the moment, but you know, disappointment from the RBA could cause a bit of a reversal in this move. Now, how much? It's hard to say. I don't actively trade the equity markets like I do, say, the bonds or the FX, but it's just something to be aware of. You can see with these candles, they've generally been up, up, up. This small pullback here, but aside from that, we've generally been one-way traffic. So yeah, another interesting thing to watch. If someone could just put the lights back on. Okay, so these are some of the opportunities that we can get trading the Aussie markets, but also you can trade the US markets and make decent money out of this stuff as well. Now, I know a lot of you don't have Aussie limits and it's not your core market, but as I've said to you in the past, you can generally trade other markets on the back of this stuff and still make money. Now, we've seen in the past with other central banks, when they cut rates unexpectedly, the US bonds have rallied, knee-jerk reaction to it, just because another central bank has done it. Now, we saw it after the Bank of Canada. The T-note went 15 ticks straight line. After maybe 5-10 second lag, it just took a bit of time to digest what had happened, and then it went, and it did reverse pretty quickly, but the knee-jerk reaction was if you bought bonds, you'd be in the money, never have been offside, and could have taken some quick, easy money. Now, that's happened a few times with the US, and the market may be getting a bit attuned to that and expecting some sort of reaction like that, and also the fact that this is actually a 50-50 call, the market won't be surprised if they cut. But chances are you'll still probably get a few ticks out of it if they cut rates, and you'll probably be able to have enough time to get into, say, buy US bonds on a rate cut and take profit fairly quickly and don't really feel any heat. By the same token, US equity markets, last time round when the Aussies cut rate, the S&P actually blipped up 5-6 handles pretty quickly. Low rates, positive for equity markets. Okay, it didn't follow through, but as day traders, we can just make some very quick, easy money. I think in this time round, it's more likely that you'll be able to make the money out of the equities doing that, because the bond markets have got used to this sort of trade pattern with interest rate cuts elsewhere. But the equity markets generally will see it as positive. Interest rate markets actually, if other central banks are cutting rates, it's actually probably a good thing for the US, adding stimulus to the global economy and ultimately feed into higher interest rates further down the line. But for equity markets, lower rates are just good news in general. So I guess, you know, the point I'm trying to make here is you don't have to trade Aussie product to make money out of this. You can trade US bonds, you can trade US equities, you can trade Kiwi dollar. Kiwi often will follow the Aussie because it's a core trading partner. You can probably trade Canada and get similar plays in the currency. So, you know, whether you trade Aussie or not, it's important to know what's going on with all the big central banks, with all the core markets, because you can make money, one, on the Aussie market, but on correlated markets, and all markets are generally correlated with each other these days. So as I said, it's 3:30 AM. Let's see how many of you are here for it. But even if you're not, it's very important, whether you're trading or not, to be aware. When you come in tomorrow morning, if you're not trading and it's not your cup of tea, you need to know first thing in the morning when you come in what to look at, what's happened overnight. You know the RBA meeting is happening, so that could be a driver of overnight moves, and you might have an open trade to do in the Bund or the Euro stocks on the back of this. So it's very important whether you trade it or not, whether you trade Aussie or not, whether you're here or not, you need to be aware, because ultimately global markets are correlated, and one market will create opportunities in other markets. And also, a lot of you wouldn't have seen interest rate cycles full stop. You might have seen the odd rate cut by the ECB, the odd move by the RBA beforehand, but you know, it's something to get good practice in. We're going to see ultimately in the next six months to a year hiking cycles from the Fed, from the Bank of England. We want to know how interest rate markets react. We want to know how sterling markets react, bond markets, equity markets, FX markets to interest rate moves. Over the last 4 or 5 years, we haven't had that much experience of seeing these things. So we want to, you know, see what happens, absorb it up, and then potentially, if we can't make any money this time round or aren't trading it this time round, there'll be opportunities next time round. Okay, guys. Any questions on anything I've been through today? Okay, great. Okay, so what we should do, you know, be on the ball. There will be opportunities, and even if there aren't, absorb, take it in, and store it for next time. All right, guys. Thanks very much. Hope you enjoyed it.
Cheers.